All right, welcome to Module 4 for Finance 304. We'll be focused on commercial banking. Now, commercial banks, as we go through this, will compare a financial institution, or what we'll say here is a depository institution. We're going to compare that to a non-financial firm, and you'll see that the way we record assets and liabilities may look a little different, and it's because the major assets of a commercial bank will include things like loans, where for most firms, loans are considered liabilities. And on the reverse side, the liabilities for one of these depository institutions would be the deposits that are being held there, where that would be an asset for a non-financial firm. But that's only true of these deposits like that. So we'll be able to compare and contrast a little bit between those two. We regulate financial institutions the way we do because we require these financial institutions to continue operation. So much like the way we regulate utilities such as water or electricity, because we're not as concerned about them necessarily making profit continuously as we are as to ensure that those services are always being provided. And so regulation is put in place to ensure that those functions will be able to continue. And this is a comparison between a commercial bank and a non-financial firm, and you'll notice how loans and deposits are a bit flipped. But you have to remember, for a commercial bank, loans generate income, and deposits, they have to pay interest onto that. So that would be part of their liability. So if you think about assets as things that generate income for the firm, and liabilities are the things that generate costs, it makes more sense to see that loans and deposits are set that way. But you also notice that financial assets are financial assets. So while deposits, switch side, that's because as a depository institution, that is a source of capital for them. And then they make loans, which are then their assets. Now, since we do call them depository institutions, you can probably guess that this is where most of their business lie, and therefore the majority of their assets are in fact those loans. So we show here the 2019 numbers, and I'm not going to read the slide to you. I'll let you pause and read through that. But the important takeaway is that the bank has these assets which are generating income. And because of that income, they're able to have, the cash flow necessary to maintain their operations. They also are able to have the liquidity necessary as a banking institution, providing liquidity into the market. So we want to ensure that they're able to do that. But they have a number of different interest-bearing securities, and in a later module we'll look at some of the reasoning for these different lengths of maturities, different levels of risk that are being taken on. And this is just to show you a distribution of assets and liabilities to get a sense for where they are investing in assets and where their liabilities lie. Now, as we said, their assets look a little different than ours, and therefore they have some risks that are a little unique to them. So the first of all would be the credit risk, right? And this is the risk that you're taking on because your loan may not be paid back in full, right? And this is also a concern that it may not be paid on time as well. So you can have late payment and you can have missed payments, and both of those are examples of this type of credit risk. Liquidity risk would be where people need access to cash or cash equivalents, and that you just would not have it available. When you were studying other finance courses, you may have learned that firms don't like to keep a lot of cash or cash equivalents because they often want those assets invested in something that will generate income, where cash does not. And banks also prefer to not have cash just for liquidity. They would prefer to have those assets in the forms of loans and that type of thing that would generate income. But this is again where regulation steps in and ensures a certain level of liquidity so that would be available in the market. And then interest rate risk is the possibility that your assets and liabilities could differ in, say, fixed rate versus variable rate. And this is common both in U.S. banking and banking abroad, although where the fixed and variable rates lies relative to assets and liabilities can differ, of course, on the market. But when you have a mismatch between that and interest rates change quickly, then suddenly the bank could be at a larger risk that they're paying out fixed, and what they're receiving could be variable and much lower as well. So interest rates up or down can negatively influence the assets of the bank. And so all of that risk that they have introduces the possibility that the financial institution is not able to adjust to some sort of change. And so the value of their assets may decline too quickly relative to their liabilities. And again, as a regulated institution, we're going to take this type of risk very seriously. When we combine those, again, we call that insolvency risk. It's just that possibility that they don't have the capital resources necessary. As we had shown on the previous slide, that the loans and investment securities are the primary assets, but you've seen this change. Have you noticed the time periods that are shown there? 92 to 2019, and then 2007, 2014, 2016. If you look back at the way the banking industry has changed, first in the 1980s with the deregulation that we'll get into later in this one, all the way through to the 2008 financial crisis, you see where banks have adjusted their holdings based upon the best practices. So you're seeing that these types of loans are declining, and hopefully that makes sense given some of the risks that we've seen in these various markets. And this is just, again, comparing year by year the percentage holdings of those various assets. Now, to switch to the other side, going from assets to liabilities, remember that what we would normally consider to be an asset, that deposit, for the bank is a liability because they're paying interest on those deposits, and they have to be able to provide the money back on a deposit depending on the type of deposit. Will set the timing. But these are just to show some going from the more liquid to the less liquid. The first are the transaction accounts. This is what we normally think about with those demand deposits. So when you're using your debit card, that would be the type of transaction that we're talking about here. We also have the savings account. So this isn't the type of thing that you would normally use for these types of transactions, but it's perhaps money that you would have saved, that you would have access to, but the number of transactions may be restricted on that. And then large time deposits, they're normally going to be things like certificates of deposit. And these are ways for you to basically deposit the money to the bank and get a rate of return. And then the bank also gets a bit of capital injection that they can use to go out and acquire more assets, such as making loans. They'll also have other liabilities that they're having to offset their assets with. So the assets will have a certain time maturity associated with that. And you hope to get your liabilities to offset that time risk as well. Prepayment versus like a refinance type of risk. And this is just to give you a sense of how those assets um, are split up among the commercial banks. And then this is to show the liabilities and then the other equity that they're holding. And then to get into the equity piece, now that we've covered assets and the liability side, the equity piece, the commercial bank will have stock. And because of that, they'll have the value of the stock plus the surplus value and then any retained earnings. If you notice on that third bullet point, the Troubled Assets Relief Program, it was also known as TARP. This was a program that was instituted after the financial crisis in 2008. And it was, again, to ensure that liquidity, because we wanted to keep financing available so that we could grow out of that situation. And banks also engage in activities that we would consider to be off balance sheet activities. And so, as you notice, there are various types of guarantees, such as a letter of credit or a banker's assurance. If you're engaging in forwards and futures, those types of derivative transactions, then those would be off balance sheet transactions. And those off balance sheet activities can lead to the creation of assets or liabilities. And then you move that off balance sheet asset or liability to the balance sheet when it is realized, like when that actually happens. So I can set things up, and then when the transaction occurs, we will properly record that. And so if you notice, there's both an earnings and regulatory incentive to do this. It's well understood. This isn't don't think that off balance sheet means it's not being like recorded. It's just not going to be part of the balance sheet because it can be misleading since some of those events may not occur, even though we've set them up to occur in the event that we're able to. You notice here they're talking about the engaging in derivative contracts. This was very, very big in the period of the large housing growth from the 90s up through the early 2000s. And banks were very involved in derivative markets to help them offset some risks that they were being exposed to. Unfortunately, some of those activities got things very entangled, which is where TARP came in to help us unwind a lot of those positions so that we could have the things move forward. And then banks will also get involved in other activities, because these can be ways for them to not only generate income for the firm, but it can also give them access to a larger customer base for additional services that they may be able to provide. And we have a next few slides. We're going to talk a bit about the industry itself, but a big thing to keep in mind is there's been a lot of consolidation that has occurred within banking, and a lot of that is because banking prior to the 1980s was regulated in a different way, and then we began to allow mergers across state lines. And then we began allowing banks to start engaging in more and more business activity that wasn't strictly banking, right? So this is where you started getting other financial services that banks were then starting to be able to provide. Now, as banks have been able to grow and take on more of those sort of non-bank type of roles, non-bank firms have also entered into some forms of lending or making capital available through what we would term shadow banking. So it looks similar on the outside to what banks are doing. However, because they are not banks, and so they're not regulated the same way, in many ways are able to provide specialized financial services that might be a bit more difficult in a more regulated environment. And so the regulation for these non-bank firms, though, prior or after the financial crisis of 2008, we've regulated them a lot more. And if you notice here, there's a comparison between the retail banking, commercial banking, the wholesale banking, and money center banking. These are where banks have found that they have a particular niche that they are able to specialize in. And then by providing services directly for what those customers need, and not looking at areas that they would have less expertise, by that focus are able to be much better at what they do, and therefore be much more profitable than they otherwise would be. And this is to show the difference, both the number of banks and how they've you see the mergers, and obviously the a lot of the under $100 million banks are part of those mergers, and then suddenly there's a lot more banks between the 100 million to 1 billion range, and then also a larger growth between the 1 to 10 billion, and then there's the existence then of the 10 billion or more. But then if you look at the total assets as well, and you see how it's the larger banks truly do have so much more of the assets compared to 1984. And this was the comparison of the top 10 banks based on the total assets back in 2019. And those are in billions of dollars. So JP Morgan Chase, that would have been $2.3 trillion in consolidated assets in 2019. And as you can imagine, size has traditionally affected what banks are able to do. When you have a smaller bank, you tend to behave differently than the large banks, because you have fewer opportunities to engage in some of those activities like derivatives trading and a lot of the off-balance sheet activities. But it also means those small banks tend to have highly localized markets. They have to have customers that are loyal, those types of things. So small banks focus generally on those retail activities, and the large banks involve themselves in those larger trades and transactions. So while large banks do engage in retail, they try to focus on wholesale because it gives them more of their own expertise, where they're able to really take advantage of interest rate spreads to allow them to maximize the value of those assets that they own. And they tend to generate a lot more non-interest income than a small bank would, again, because they're engaged in so many more of those outside activities. Feel free to pause this slide to read over it, but this is just to let you see how the industry has performed. This leads from the turn of the millennia up to the early 2000s. And then obviously we had that recession which occurred, and so you see the changes there, both return on assets and return on equity. And while we did go through very difficult times back in 2008, you see by 2019, the banking industry was again doing well. And this is just to show you the banking industry over 30 years, just so you can see how the number of banks themselves went down, total assets went up, net income definitely went up, although 2009, you really see that year stand out following the 2008 crisis. Also understand that when we talk about the banks being regulated, this occurs at a lot of different levels. FDIC ensures that the deposits for commercial banks, so the deposit institution is buying insurance basically for this, and then in the event there is an event, the FDIC can come in and they'll step in to take care of the depositors in that case. We also have the Office of the Comptroller of the Currency, and they basically charter and, if necessary, close national banks. So they're the ones that are ensuring these banks are operating effectively. The Federal Reserve System, I know you've heard the Fed or the Federal Reserve. And so we have this to act as basically our central bank. Is not controlled by the government directly, but instead it's through this indirect system. And while we do have these federal regulators and these things at that level, we also have state banks. Traditionally, when banking began in the United States, it was these state regulators. And so we've maintained a lot of that. Although, if you remember a few slides back, I mentioned that Congress improved a lot of cross-bank merger legislation to allow for that, but the state banking regulators are still very involved in their state banks to ensure that they're functioning properly. . And this is to sort of show where all of those are. And you notice that there's a um, each of the different levels, you see how their banks are broken out. And before we looked at U.S. banks, and you see those U.S. banks listed here, but then you can see it compared to other banks in the world. And several of those are much larger. The fourth largest ones listed there are part of the Chinese economy. And this is really just to talk a bit about the advantages and disadvantages of going global. So obviously, as with any other company, once you start going global, you have a lot more innovation. You have access to these new markets. You're able to scale out your costs a lot further. So there's a lot of advantages that come with that, but your costs necessarily go up because you have to understand these different legal environments. You have the possibility that you could be nationalized. This doesn't happen very often, but it does happen. Expropriation is when assets are taken, but not the entire firm, right? And then the fixed cost is a disadvantage. If I'm building more and more of these sort of international activities, I'm necessitating certain sections be larger, even if they don't generate much business, right? So I have these fixed costs that hopefully I'll be able to scale across. But in the event of a market downturn, I may be stuck in a position with these large fixed costs. Now, one reason that people want to spread globally is because of the risk management. But what we saw in the 2008 financial crisis was that the interconnectivity of these banks meant that there was the financial problems began going into other markets. And some of those markets were very illiquid relative to, say, the US market, which caused them to be hit particularly hard. You may be aware of the crisis that occurred in Europe following this. Greece had a debt crisis. We had a number of other Euro nations, and then Portugal, Italy, and Spain are listed there. But they were all in this credit crunch where they were not able to make good on a number of payments, and they had to step in with the EU, and they had to privatize a lot of things that were owned by the Greek government. So the Greek government basically had to liquidate a lot of their holdings, and so the Greek citizens, in effect, had backstopped this. You may also be aware of Brexit. And so this was written prior to December 31st, 2020. But Brexit again disrupted European markets because the European clearing was done in London. And so with London saying that they don't wish to be part of the EU, it just became very disruptive for their trade. So now that we've talked about these banks and how we evaluate their assets and liabilities and shareholder equity, it does bring into the question, why are we evaluating their performance? Okay, and so we're going to begin evaluating the performance of these commercial banks, and we'll see how to do that. One of the ways they're going to do this is through something called CAMELS. CAMEL stands for capital adequacy, the asset quality, the management, the earnings, the liquidity, and the sensitivity. So when we're talking about the capital adequacy, we're just trying to determine if they have the capital necessary to react to some sort of change in those assets. The asset quality, just looks at are those assets going to be collected upon, right? Or is this going to be something that may be an issue because they are not going to be performing loans? The management obviously is looking at the management of the bank. The earnings, the liquidity, the sensitivity are, as you would imagine, looking at are the earnings are adequate to offset the costs that they're incurring with those liabilities. Do they have the liquidity necessary? Again, this is a major function of banks. And then looking at how sensitive they are to risk, right? As things change in the global market, what impact is it going to have on the financial institution? And they give them a rating in that of 1 to 5, where a 1 across the board would be, the very best possible firm. Where if it were a 5, this would be a troubled bank that would be very concerned about. Okay, the financial statements for these financial institutions follow a very strict format. This is the Federal Financial Institutions Examination Council uniform standard. So they have a report of condition, which acts as the balance sheet. So it would report on the assets, the liabilities, and the equity stake. And then the report of income would look like the income statement, which would show the revenues and expenses, and then the net profit for the bank. And then we know that these financial institutions will also have off-balance sheet activities, which can generate assets or liabilities. Okay, so as qualifying assets, cash and cash due. These are going to be the cash that's available there for the bank to do operations. But this is not a thing that generates income. This is just for providing that liquidity. So we don't wish to have too much cash because of that. And then the next most liquid would be the investment securities. And these can be everything from Fed funds that we've sold. It could be repo agreements that we have. It could be securities that are issued by the U.S. Government, which would be U.S. Treasuries, or they could be securities issued by states, which are munis. And so they do generate some income, and they're very liquid. That's what I'm saying. It's not cash, but it's the next most liquid. So we can usually go and trade these when we need to. Next would be the loans and leases. So as you can imagine, as a bank, if I'm making a loan, I'm going to receive principal and interest payments, right? And so as that comes in, that's going to be able to generate revenue. However, this is not a liquid asset, and so we have risk associated with it, both because we have to be concerned that the person may not pay us, that would be credit risk, or that we will not have sufficient liquid capital to operate, which would be the liquidity risk. Switching to the liability side, again, remember deposits are treated as a liability for a bank because they generate these costs, right? And so paying interest would be an example of those types of interest, although demand deposits generally do not have a stated interest. If you think about, again, your ability to use those like checking accounts immediately. And then as we go further, individuals can have retail CDs, which are below 100,000, or wholesale CDs. You also hear it called jumbo CDs if it's over 100,000. And then they can have other types of investments. There's also borrowed funds. And so you notice Fed funds and repurchase agreements are again listed, and that's because the Fed funds buying and selling, and then the repurchase agreements. So you have the repo side and the reverse repo side. So it could be an asset or a liability depending on the side that you're taking, and then other borrowing such as the BAs, commercial paper, those types of things. And then assets are balanced against liabilities and this shareholder equity. And so that equity capital piece will be there as well. This is the value that the shareholders have. And these off balance sheet items, these are the ones that are showing off the balance sheet, but in the event that that event occurs, then it would move to the balance sheet. So it's contingent upon some future action. And a couple of examples using letters of credit are listed there, just to show that we may enter into the agreement, but until you actually act on it, it won't show up on the balance sheet. And then the loan sold, right? This would be I had a loan and then sold it to someone else. And then derivative positions are other ones that could be off balance sheets that when acted upon would then move to our balance sheet. And these are other activities that banks can be involved in that will generate fees. So we're going to look at what's being generated by the assets and the liabilities. And then we're going to also talk about this other fee activity when we're looking at total income for the bank. But we do often look at this separately. Okay, so moving from the balance sheet to the income statement, this will be very similar to what you perhaps have seen with non-financial institutions, but we do have this off balance sheet activity that we have to also make sure we're properly accounting for. Okay, so as we go through this, understand that the net interest income is all of the money that they receive in interest minus all of the money they pay out in interest, right? And so this could be positive or negative. It would be negative if they had to pay out more in interest than they were to receive. The provision for loan losses is money that we've set aside because we expect a certain number of loans to not not be paid, basically. And so, or the losses that we would incur, we set that up. As mentioned in the previous slide, the non-interest income would be all these things that we could do that's not from interest, right? And so if you take all of the interest income and then all the non-interest income, that would give us the total operating income. Okay, so once you have that, you have income before any taxes or extraordinary items. Right. I know it sounds a little different because we normally say before interest and taxes, but we've dealt with interest at the very beginning with the bank. So it's treated again very slightly differently than the way we normally talk about non-financial institutions. You then pay any taxes from your profit, and then any sort of extraordinary items that you have to have for that particular period. And then removing that would give you the net income. And this is the same thing in a mathematical form, but let me just sort of walk through that. So NI is the net income. It is equal to the return of every asset in, right, times that asset dollar value. So if we have $1 million that gets 2%, then it would be 2% times 1 million. And then maybe we got 5 million that 1%. So it'd be 1% times 5 million. And you would do that for every one of your asset classes, right? 1 through N. And that's what that giant sigma means. You're just going to do that for every one of the assets. And that gives you the total interest income, and then minus, and then you see again the rate times L. That's the rate that you're paying, and then for every one of your liabilities, 1 through M, right? And so that's your interest expense. So again, just like what we were showing before, interest income minus interest expense, and that's what those first two sigma parts of the equation are. Then we have to subtract off P, and that's that provision for the loan losses. We know we're thinking we're going to have this income, we're thinking we're going to have these losses, but then also someone may go bankrupt on us, right? And so we know that there's going to be some percentage of loans that are not going to be in compliance, and so we have that provision as well. Okay, and then you see the NII, NIE. This is the non-interest income, non-interest expense. So that's that non-interest piece that we were talking about. So these are all the things that they're doing off balance sheet or what have you, but it's not related to their assets or liabilities. This is just other activities that they're engaged in and generating income. Then once we have all that, we subtract off T, which is our taxes, right? So net income is all of our interest minus all of our interest income minus all of our interest expenses minus our performance of bad loans plus the non-interest income minus non-interest expenses and then minus taxes, right? And this is an example using some dollar figures, and you can see you can have so many millions in assets and so many millions in liabilities, and they can have different rates associated with them. This is very common, actually. And so as you calculate net income, if you were to sell assets that are at one, the rate of 4.6, and you're adding instead assets that are earning 6%, then you're going to generate this additional income. And you see it broken out there. You can see it's going to be a net increase of $7,000. And if you do the full calculation, you see that you go from 73,500 to 80,500. So it's that 7,000 increase. Okay. We can also talk about this as return on equity. Whenever we say return, almost surely we mean net income, right? And so this would be like the net income divided by equity. And this is often the best way for us to frame our analysis, right, for this. And we're going to look at a number of ratios that will allow us to not only do what we call time series, but also cross-sectional analysis. So time series is when I look at a firm in year 1, 2, 3, 4, 5, and see what is going on with our profitability index or what is going on with our asset utilization, right? And I can see over time if they're becoming more or less efficient. Cross-sectional analysis is using those ratios which help us account for the firm size so that we can compare firms that perhaps are different sized. But I could look at competitor banks and see if we're over or underperforming relative to our peers. Excuse me. As I just said, return on equity. Anytime you see return, then you probably should think net income. So return on equity is net income divided by equity, the total equity capital. And we can first decompose that into two parts. Return on assets, so it'd be net income divided by assets, and then the equity multiplier, which is total assets divided by total equity capital. You may also see that written as 1 plus debt over equity. If you were to write 1 as equity over equity, equity over equity plus debt over equity would equal assets over equity. So it means the exact same thing algebraically. So if you were to see that again written 1 plus debt over equity, understand it algebraically, it is the exact same thing, and that is our equity multiplier. Okay. And then the return on equity, or sorry, return on assets itself, right, can be broken down into two components, right? The profit margin and then the asset utilization. So the profit margin is the net income divided by the total operating income. So what we're saying is, how good is my company at taking the dollars at the top of the income statement there at revenue all the way down to the bottom, right? Like that's what I'm looking at. Am I really good at minimizing any costs incurred with that income, right? And that's what we mean by that profitability. Your income at the bottom divided by the operating income. Then we're going to multiply that by the asset utilization, which is how much is that operating income I'm generating, like our sales, if it was a non-financial firm, right? That's normally what we think of there. But that total operating income divided by total assets. Do I have a lot of assets tied up in big buildings, which don't generate income? Or are most of my assets in these financial assets, financial instruments that are going to generate cash flow, right? And that's what that asset utilization is demonstrating. Right. So like I said, profit margin measures the ability to control expenses, and asset utilization is, am I using my assets to generate income, or do I have a lot of things tied up that do not generate income? Other things that we'll want to look at, the net interest margin, and that is to let us know what is the return on the earning asset. So we pull out things that are not part of those earning assets. And then the spread is the difference in the yield on my assets and then the cost of my liabilities, right? It's the yield spread. So if I'm receiving 6% and I'm paying out 3%, right, then my spread would be that 6 minus 3 or 3%. Overhead efficiency is looking at all that non-interest side. So, we were focused first with the interest received from assets minus the interest paid on our liabilities. But if you're looking at that non-interest side, this is looking at that and how much income we generate divided by the expenses that we generate. Feel free to pause this slide and read over it, but it's just really just a comparison. As you can imagine, smaller banks tend to be smaller. They're regional focused. They have a very specific core business that they focus on, where large banks tend to go into areas that allow for higher profitability, but also will require higher capital requirements. All right, and that will conclude module 4. If you have any questions or concerns, please just email the professor. Thank you.